Now, how much would it cost us to get one lot of this? Well, we know that one lot, okay, one lot here is going to be 100,000 of the base currency, which is USD, times 1.35251 is going to give you 135,251 Canadian dollars. That's the contract value. That's how much it's going to cost us to get this one lot, right? And don't worry, we're going to talk about leverage in the next lecture, so you'll know that it's not going to cost you that much. Now, the pip value is the profit that you're going to make for each one pip movement. So what's one pip? We know that a pip is 1, 2, 3, 4 decimal places after the zero. So it's 1 here, right? So that's a one pip movement. So we want to know what happens if the price goes to 6 here instead of 5. Okay? So instead of having 5, it goes to 6, or it goes down to 4. It moves by 1 pip. Well, let's see. What would be the contract value if the price went up by 1 pip? So to 1.35261. Well, the contract value would be 100,000 US times 1.35261, which gives us $135,261. Now, the pip value, so in this case, if this currency moves up by 1 pip, how much money would we have made? Well, we would have made 135,261, the price at which we're selling, minus the price at which we bought at, 135,251, we would make $10. Okay, $10 in Canadian. Now, if you want to know how much you made in the base currency in USD, well, all you would have to do is do the $10 divided by the exchange rate, which in this case, it would have given you 739 in US. Okay. Now, when we're talking about pip value, it is usually calculated, well, it is calculated in quote currency. So when we're talking about pip value, you're usually talking about quote currency. But if you want to look at it in the other currency, you can do that. The value of the pip is going to be based on how many lots, right? So in this case, I calculated that you bought 1 lot. But imagine you didn't buy 1 lot and you bought 0.1 lot, right? Because you didn't want to spend 100,000 US, you want to spend 10,000 US, right? Well, in this case, what would have been your pip value? It would have been 10 times less this. So it would have been $1, your pip value. If you wanted to trade 0.01 lots, okay, so 100th of a lot, meaning you just wanted to trade in 1,000 increments, well, what would have been your pip value? Well, 10 times less than this one. So it would have been 10 cents, right? That would have been your pip value. So the pip value is going to depend really on the lots, the size of the lot that you're using. Are you trading 0.1 lot, 1 lot, 10 lots, 100 lots, 2 lots, 2.5 lots? It depends, right? But based on the lot that you're using, you're going to be able to know that, okay, well, each pip that this currency moves, I'm making $200 or I'm making 75 cents. So that way, when you're going to be looking at prices, and I'm going to pull something up here. Let's say you're looking at USD CAD, and again, we'll look over charting soon. You'll know that, okay, well, look, if I'm doing 1 lot, I'm making $10 per pip. You know that if the price goes, let's say, from here all the way up to, or let's say from where it's at now, 33408, and it goes to, I don't know, let's say 628. Well, you can calculate that the difference between those two prices is 22 pips. So you'll be able to say, okay, well, 22 pips times, $10 per pip, I'm making $220 if it goes from here to here. And because of this, you'll be able to, calculate how much profits you can make or how much you're willing to lose. And we'll be able to use that for other calculations as well that we're going to get to later on. But, this is the calculation. Now, a way to do this is very easy. There's a simple formula to calculate this. And the pip value, you can, conclude that it would be the lots, how many lots you're using, times 10. So that's the simple version of the calculation. So if you're trading whatever you're trading, you can say, well, okay, if I'm trading 1 lot, well, 1 lot times $10 is going to give me $10. That's the pip value. If you're trading like we said here, 0.1 lots, well, you would do 0.1 times $10, and then this gives you $1, right? The same calculation that we came earlier with. If you were trading, 0.01 lots, you do that times 10, and that gives you the 10 cents we calculated earlier here, right? So this is a simplification of the formula, so you can just use that if you want. But later on, I will be giving you an Excel sheet that does all of these calculations for you. But I still want you to learn them. I still want you in the beginning to use a calculator and to test it out. Now we're just looking over all these, terms, but we're going to be using all of them at one point later on in the course. So don't be overwhelmed. And I'll see you guys in the next lecture. Leverage is going to be another term that you want to be familiar with, because trading Forex cannot be done without leverage. Okay, so what leverage is funds that your broker loans you. Okay, so your broker, whoever you're transacting through, is going to loan you these funds so you're able to transact with more money. Why? Because in the foreign exchange market, as you've seen, movements are very small. So for you to make any type of considerable profit or even loss, you have to trade big. Okay, and unless you have big capital, then it's not going to be worth it. Which we've talked about. You're not going to buy for $100 worth and expect to make money. It won't work. So you need to borrow huge funds from your broker, trade with that, so your trades have bigger impact. So brokers can loan you huge amounts. Okay, they can loan you up to 1,000 times your money, which is crazy, right? You don't get that in stocks. You don't get that in other markets. Just in the FX world that you have such high leverage. Now, it's not because you have access to 1,000 times your money that you should get that. Different brokers are going to give you different types of leverage, but we'll talk about more of that later. For now, what you need to understand is when your broker tells you, and when we go to look at brokers, you'll see that each broker has a different leverage number that they'll give you. This is how you read it. When you see leverage 1-to-1, that means you're not getting anything extra. Okay, it's your own capital basically, which no Forex broker gives you that. Okay, what would 1-to-1 mean? It means that your margin requirement, margin is how much money you have to put in to get the amount that you're going to trade. Let's say you want to trade for $100,000. Well, if the margin is 20%, that means you have to put up $20,000 of that $100,000. So it's the margin required to trade all that capital. In this case, the margin requirement is going to be 100% because you're not getting any help. So if you wanted to buy one lot, you would need to put up $100,000, right? Depending what the base currency is. Now, if you get 2-to-1 leverage,